Advanced Financial Accounting Excel Practice Problem. In this presentation, we'll take a look at a practice problem in Excel that will go through the acquisition and then liquidation process. It will be a more detailed problem. In other words, we're going to have one company acquiring another company, acquiring the net assets, and then the company that has been acquired will then be liquidated. Get ready to account with Advanced Financial Accounting. Here we are in our practice problem. We're going to have the information on the left-hand side. We're going to enter that information into the blue area on the right-hand side, including the journal entries here, and then we're going to be posting that to our trial balance to get an idea of the balancing concept and the effect that it would have on a trial balance with the actual accounts affected here. This will be a bit longer of a problem. It doesn't really make it more difficult that it's longer. And we'll see that. We'll be able to see how this is just going to be a long journal entry, but the idea of the journal entry is going to be fairly straightforward. So let's go through this process. We're going to say, all right, on the left-hand side, we've got our information. P issues shares to S. So the situation is going to be, P is going to be purchasing the net assets of S. So S is going to be purchased completely, the net assets purchased, and then the S corporation is going to be dissolved or liquidated so that we're left with only P, who has now acquired all the net assets of S. Okay, so we got they're going to purchase, and they're going to do so by issuing shares. So P is going to issue shares to S to purchase all of the net assets, and then in essence, S will be liquidated at that point. So the issuance will be the 182,300 shares, par value 2, market price 14. So we'll take a look at that. And then we have the cost to set this up is going to be 135,000. That's going to be the cost of setting this thing up. Then we have the cost for the issuing of the stock itself of the 48,000. All right. And then S exchanges all assets and liabilities and then is liquidated. So we're going to exchange, the S is going to, all the assets will be purchased by P. S will then basically be an empty shell at that point and will be basically liquidated at that time. So S balance sheet prior to combination is down below. So this is going to be the numbers that we have that we're going to be using for S. So S has this information down below. Note that in essence, we have kind of a sale type transaction happening here. It's not that P is creating S out of nowhere, and which would be more of a restructure kind of situation. They're purchasing the net assets of S. So purchasing basically, taking like the guts out of S, right? Taking everything they are, the assets minus the liability, purchasing that, leaving S with basically, a shell at that point, which would then be liquidated at that time. So what we'll do is we'll record this. We're going to look at the information on S to see what is purchased. To do that then, whenever you have this market type of transaction, they want to be used the fair value, and that means we have to revalue everything as we put this onto our books as P. And then S, we're going to record S then, having all of their guts taken out, right? All of the assets and liabilities being removed and being left with basically a shell, which we will then liquidate. So we'll record both sides of this thing. So the main point is that on P's side of things, we'll start up with P. What is P going to be getting? Well, they're going to be getting line by line the assets and liabilities that they're going to be purchasing from S. And we're going to have to get those at fair value. So we'll have to revalue this thing. Again, that's a long process to do in practice, of course, not an easy thing to do. But once done, once you just have the numbers at fair value, then the recording of the transaction, not all that difficult, right? So that's where we stand at this point in time. We're just recording the transaction. Now, I'm actually going to record the costs first. So let's say, okay, we got the costs to set up the combination, and then we have the cost for issuing the stock. So those are kind of two different things. For the cost of setting up, I'm just going to expense those. Those are going to be costs of the merger. So that's going to be just like any other expense, the expense of doing business. So I'm going to say, all right, we're just going to expense those. So let's start off there. I'm going to say, all right, and then way down here, we've got the expenses. And we're just going to call them merger costs. And they're going to be an expense down here. So, okay, so we're going to say merger costs. And that's going to be for the 135. So the 135, and then we're going to be paying cash for those costs. So cash is going to be going down. Now, obviously, P's books over here, we're starting off with a beginning balance that's very, not much going on. We just have cash in P. P's there just to buy stuff, okay? But we're going to record the transaction. I want to be able to post something over here. So all I got is cash. We got the retained earnings. We've got the revenue at this point in time, so we can compare it to the merger costs. that we will be having and see some basically net income here. Then we're going to be posting and all the stuff that we're going to be getting from S right now. So you can imagine P is basically just an investment company. We pulled up cash together and we're out ready to purchase stuff, and we're purchasing S. All right, so there's going to be that. Let's go ahead and post that out. We're going to say, all right, well then cash is going to go down. All we have is cash here. So in K3, I'm going to say this equals cash is going to be decreasing. We're going to go down to the merger costs here in K23 equals, and scroll back up top. And of course, this is just going to be an expense. So we just expense that. That's going to affect net income. So that's just normal expense. Now these other ones, we're going to be putting in as part of the cost of the issuance of the common stock. However, if we incur these costs before the issuance is complete, then we're going to have to record them in basically a holding account. So we've already, let's say, incurred costs. We've got to credit cash. And then we have to put the other side into a holding account until we complete the transaction, which is going to be an asset account because it's going to be something we're going to consume in the future. So in other words, we're going to say, okay, we spent money, and that means cash is going to go down. So I'm going to say there's going to be a credit to cash, and that's for this 48,000. Now it's going to be included as part of the issuance of the stock and therefore included in additional paid in capital, but we're not done with that yet and therefore can't record that journal entry yet. We got to put it somewhere in the meantime. That's going to happen in the future, and therefore this cash was spent for something that will happen in the future. That means it's going to be an asset. So we're going to say that's going to be an asset. It's going to be, let's call it deferred stock issue costs that we'll then going to decrease. We're going to put it in the books as an asset now, which we will then decrease when we issue the stocks and can apply it out properly to that issuing process. All right, so then we're going to post this. I'm going to say in K6, this equals the deferred stock issue costs, and then cash up here in K3, something's in it. So I'm going to say F2 plus F2. Scroll back down, and we're going to pick up that credit to cash of the 48,000. The cash credited there, and there we have our we're back in balance with the green zeros. All right, now let's record the actual, just all the information that we're going to get on our books, all the stuff that's coming from S. So this is S's balance sheet on a book value and a fair value. We're just going to pull over all the information from on a fair value, and that's what we got, right? So it's a really long journal entry, but once we know what the fair value is, that's really the difficult part, negotiating that, figuring that out, getting actuaries, whatever we got to do to get the fair value. Once we know what that is, then the journal entry is long, but not that difficult. So all we're going to do is just go straight down the balance sheet and say, all right, there's cash. Now cash is cash. It wasn't hard to see what the fair value was with cash, but we're going to debit cash because our cash is going to go up by the 21,000. Cash is going to be the same fair value, book value, because, you know, cash doesn't change much. The accounts receivable, we got that. Now that had an allowance account down here. We valued it here. So we're just going to put it on the books at what we valued it at. So we're going to say, all right, here's the accounts receivables worth the 237.7, the 237.7. Then we're going to be picking up the other assets. So other assets. Now notice from a bookkeeping standpoint, you might be thinking, well, it's a little more difficult than that because, you know, if I put the accounts receivable on there, I need to track the subsidiary account, and I need to track, you know, who owes us the money so we can collect on it. And that is more difficult right here, right? So we're thinking of the overarching journal entry. In practice, you would need to drill down on some detail for that accounts receivable and make sure that you put the subledger in there and all that kind of stuff. So from an accounting standpoint, that does get a bit more complex here. So we'll keep that in mind. We're going to say the other assets. So other assets, we got those two. Then we have the long-term investment. So, okay, long-term investment, that's going to be going up. No problem. Land. So then we got land. And there it is. Now it's going up in value, so we had to revalue the land. So we actually looked at the land and appraised it or something to get it revalued to the fair value, what we think it is. And then the investments. So we had investments that are at the 59. And then we had the building and machinery. Now this is the property, plant, and equipment. We're going to put it on the books for the $2,482,000. Again, we had to revalue that. And notice they have here the building and the accumulated depreciation. Now, I don't have to think about, you know, when I revalued the allowance, we would have to kind of think about how we're going to do that from a bookkeeping standpoint compared to accounts receivable. Down here, we're just going to put we have to then value each piece of building and machinery, right, to whatever the fair value is, and then we're going to start over with the accumulated depreciation. So this would be putting it on the books kind of like cost, you would think, right, at this point in time, cost to us. We don't need to pull over their accumulated depreciation, but we do need each individual building and equipment that we're going to have a sub-schedule for that we can then track the depreciation from that point. Then we're going to say we got the intangible assets here, and we're going to be picking those up. Again, once again, we'd have to say what are the actual intangible assets, and then assign a value to each of them. So we need some more sub-detail, but from a overarching standpoint, the journal entry is pretty straightforward. We can say we have licensees, another asset here of the 98.2. All right, then let's go to the liabilities. We're picking up the liabilities. We're going to incur the liabilities as we purchase the corporation here. So I'm going to put these on the credit side. I'm going to say negative of the 138.1 for the liabilities for credit. We're going to pick up the notes payable. So notes payable, we're going to say is a credit. So I'm going to say that with a negative of that number. And then I'm going to say, all right, then we have the other liabilities, which we're picking up. So other liabilities, it's going to be a credit of the 103. Then we have the bonds payable, which we're going to pick up at the fair value here of the 1040. So there we have it. So that's what we got. So I mean, and if you add up the assets minus the liabilities, what we got was a net of this 2,206,800. 2,206,800. What did we give up? What did we pay this for? We didn't pay cash for it, but rather issued stock. So when we issued stock, we got to compare that to what the value is of what we issued. And we can't just assume that the stock that we issued is equal to the 2,206,800. Why? Because even though we've valued these, we've revalued assets and liabilities, and you would think we could do that. We can't, because there could be stuff that's not on the balance sheet at all. There could be intangibles, goodwill. There could be goodwill. So you can't just say, oh, well, I know I've revalued all these, so the consideration that I'm giving, which is stock, and what if I don't know the stock because it's not publicly traded, then it's still not good enough because this doesn't represent what could be there, which is goodwill. So we have to value the stock too. Now, if it's a publicly traded company, that's not too difficult to do because we could see what the stock is currently traded as. So that's what we have to think about now. So we're going to be issuing the stock. So we're going to compare that to what we're giving the stock. So common stock is what we gave up. It's got a $6 par value. So I'm going to say this is going to be, I'm going to say negative. I'm going to do a little calculation up here. And we issued this many shares times the par value, which is $2. I'm saying the par value is $2 up here. So in our problem, so over here it's $6. I think that's a typo. I think that should be $2. Let's adjust that in our problem here. I think this should be $2. So apologize for that, because I think that's what we're looking. Okay, and then so we're going to multiply. That's the par value. And then we have to think, okay, what's the difference between the market value and the par value? So the market price we're saying is $14. So then if we pull out the trusty calculator here, so it's a little bit easier to see than in an Excel formula. So the trusty calculator, well, $14 minus $2 means a difference of $12 times the 182,300. That's going to be the difference, right? So let's take a look at that. We're going to say, all right, let's do that with a formula. I'm going to say this needs to go into the additional paid in capital. Additional paid in capital here. And that is, let's do the calculation. I'm going to say negative brackets. And then let's go back up top and I'm going to say 14 minus 2, which is 12 brackets, times the 182,300 that we issued. And there it is. Now, if we added both those up, that's going to be the 2,552,200. If we pull up the trusty calculator here, trusty calculator, the huge trusty calculator. The calculator gets mad at Excel, so when I whip out the calculator, it has to show off by showing the whole screen like that. So then we're going to say 182,300 times 14, the market price. there's that 2,552,200. So and then that's going to be the sum of these two, right? The 2,552,200. So we're breaking it out between the $2 par and then the additional paid in capital. Now we're not quite done because you'll recall that we also had this issuing item up top. And we said that was going to be part of the issuing cost. Now you could work this in to this calculation for the additional paid in capital. I like to just do it separately. I think it's easier to see. So I'm just going to add this to the journal entry. I'm going to say, all right, well now I've got this issuance cost that needs to go down. So I'm going to go back up top and say this issuance cost thing, the deferred stock issuance cost needs to go down. And that's for the 48. So I'm going to say negative 48,000. The difference then of that is also going to be going to additional paid in capital. So it's going to be included basically as part of the issuance cost. So now we're still not going to be in balance because we want to determine now if we have that intangible asset, which is going to be goodwill. So you can think about this in this way. Let's pull out the trusty calculator again. So the giant trusty calculator. Here I am. And then we're going to say, all right, so this is the net assets here. So net assets are at the 2206,800, right? So we have the 2206,800 minus, that's what we got, net assets minus liabilities at a fair value. This is what the value is of we gave up. And you could highlight these two, or these two kind of net out, and that's going to be the 2,552,200. So minus what we paid in terms of common stock, 2,552,200 is going to be a difference of the 345,400. So we paid more, the 345,400. Why? Because we assume there's an asset of goodwill in there, some kind of intangible asset like the brand name. We can also do that with a negative sum formula, the way we set this up with the use of the debits and credits, which I could just say negative sum of all this. This is the plug formula, which makes it nice and easy to do in Excel, which is one of the reasons why I would recommend setting it up this way. Now, note that the goodwill account was not here until I just added it. So there's the goodwill account now that we have just added. And I'm going to then put it up top here. Goodwill is an asset account. And there we have it. So now let's go ahead and record this out. So something's in cash. I'm going to double click on it, go to the end of it and say plus. And then I'm going to go over that 21 and enter. Then the accounts receivable, I'm just going to say, I'm just recording these items over there, right? So accounts receivable equals the accounts receivable, enter the other assets. I'm going to record the other assets. That's going to be the 376. And then I'm on the long-term investment equals or plus. That's going to be the 171. Goodwill, I'll do that later. I'm going to go down to the land here because that's the next one just in line of our journal entry. That's the 85,000. Next one's going to be the investment. Let's pick that one up, the investment of the 59,000. Then we have the building and machinery. So let's pick up the old building and machinery. Then we have the intangible assets. So intangible assets. There we have that. And then the license. So we'll pick that up, the license. Obviously, in practice, we would have to add maybe some of these accounts. If we didn't have these accounts on the books, I included them in our trial balance, so it's nice and easy to just go in there and add them, so it wouldn't be quite so so easy to put them into our books, but you can see how the journal entry would basically work. So we're going to say accounts payable is a liability. Then we have the notes payable here. Oh, that's not the right, that's the wrong account. Notes payable is that one. And then we have the other liabilities. Then we've got the bonds payable. Let's pick up the bonds payable. All right. And then we've got the stock that's going to be issued. So the stock is issued at that. And then we have the additional paid in capital for it. So here's the additional paid in capital. And then we have that deferred thing that happened up here that we had. Remember, we put it on the books as an asset up here. Now it needs to go back down to 0, so we're going to double click on it, go to the end of it, and say plus. This is going to go like back down now. So that went back down, and now it's back to nothing because we consumed it because it's part of the issuance cost down here. So it's part of the issuance cost, so it's in additional paid in capital. Double clicking on this, going to the end of it, plus. There's the 48 there. Then we have the goodwill. Goodwill is going to be an asset, so we'll put this up top. There's going to be our asset account. equals, and there it is. So the parent company recording all the assets, liabilities into their books, and everything lines up, and we're back in balance here for P. All right, so what happens to S then? What happens to S? And well, S got its guts ripped out, right? So everything that's on its books is basically represented by this number here. This is its book value. Then we revalued it to fair value. So its book value, assets minus liability, are now gone. They've been removed. The guts have been removed. So we could just go down their books and say, okay, everything that was there is now like gone, right? So that's pretty straightforward journal entry. It's long, but straightforward type of journal entry here. We're just going to say, all right, well, you had cash, but now it's gone. So you could just say credit. It's kind of like a closing entry where everything just gets wiped out, right? So we're just going to say cash is gone. I can just copy this whole thing. Receivables, we got the allowance. So receivables is, I'm going to say negative. What am I doing here? I got it on the debit side. Hold on a second. Cash is going to be having credit to be gone. Now, I'm not going to pick up this number over here. I'm going to pick up the beginning number. If I pick up this number, it's going to cause a circle reference. So you want to just, pick up the first number. I'm just going to say accounts receivable is going to go away. Now, this is a contra asset account, has a credit balance, so we're going to have to debit it to make it go away. So I'm going to debit that one to make it go away. And then we've got the other assets. It's got to be credited to go away. So we need to credit that one. And then we have the long-term investments. We're going to need a credit there to make it go away. And we have the land that has been purchased. And so we're going to credit it to go away. And then we have the investment. I just need an equal investment. And we're going to credit it to make it go away. And then we got this building, and we need to credit it to make it go away. Then we have the contra asset of accumulated depreciation. It's a credit balance, not a liability, but we need to debit it to make it go away. So debit it to make it go away. Intangible assets, we're going to credit those to make it go away. And then we've got the license here. So we're going to credit that to make it go away. All right. And then let's go to the liabilities. We've removed them as well. So here's the accounts payable. It's got a credit balance. We're going to debit it to make it go away. And then we've got the notes payable, and we're going to debit it. Actually, I need to make it a debit like this. And debit it. Now, notice I'm always hitting negative to flip the sign here when I pick up the numbers. The other liabilities, we need to debit it to make it go away. The bonds, I'm just going to pick up the bonds. And we need to debit it to make it go away. So the bonds, we'll debit that. And then we have the discount. It's got a debit balance, so we're going to have to credit the discount because it's reducing the liability of the bonds. Therefore, it's a contra liability account. And we're going to have to credit it to make it go away. Now, there's all of our assets that are and liabilities, right? And so I'm not going to go down to the equity section right now. Well, I'm going to basically compare what we gave up, just like a sale. If we just sold a piece of equipment, I'm going to compare what we gave up on a book value method to what we received. And then we'll have to see if we recognized any gain or loss on this transaction, right? So what did we get on this? And then we'll continue to liquidate. Then we'll be left with basically nothing but, liquidation. So, okay, so then we're going to say, well, what did we get? Well, we got an investment in P. Investment in P is what we received. And what's going to be the value of that investment? We're going to say this is going to be equal to, and we're going to use the same market value. We bought 182,300 shares times the market price, or $14, right? So we're going to say 14. There it is at the 200. And that's what's received over here. Now that'll look familiar because that's what we gave up on P's side. On P's side, we gave up the common stock par plus the additional paid in capital of the 2,552,200. So we gave up this amount. If this was cash, you can imagine it being cash. It would be easier to see, right? It's a little more complicated with a stock. We would say credit cash, and then the cash would be the thing that we got on this side. In this case, we credited the value of the stock here, and then that's what was debited on this side as the investment. So this is what we gave up then, the net, assets minus the liabilities. And notice I didn't try to make debits on, debits first and credits not, I just did this top to bottom because I think that's the easiest way to see it. So then we're going to say, all right, let's do this and highlight this, assets minus the liabilities. That means that we gave up, and if we pull up the trusty calculator here, the giant trusty calculator, and we highlight all this, we're going to say this is going to be the 115. Oh, not there. That's not where it goes. It goes in the trusty calculator. If we add this up, it goes 1158600 minus then what we got, the value 2552200. That's going to be a difference of, let's do that one more time. So what we got was the 11586. I did it again. So let's do it again here. So what we got is this number, the 1158600 minus that's what we gave up. What we got, 2552200. So that's a gain of 1,393,000. Okay. So then we're going to say that's going to be our gain. We're going to have to say that's a gain. I'm going to record that on the income statement for now. So notice we were looking at basically everything on the balance sheet. You want everything closed out before you do, this process, kind of have like a post-closing trial. You want to look at the balance sheet. But now I'm going to record this on the income statement, and then we'll close out the income statement. Now, the other way you could do this is a negative sum formula. A negative sum, and that'll give us our gain here. So negative sum of all that. And there it is. So there's going to be our gain. Now, if we were to post this out, then we'll post out this long journal entry. It should remind you kind of like of a closing entry. We're just going to clear everything out. So cash is going to go down to 0. So then we got this one is going to go down. Accounts receivable. The allowance is going to go down, right? And if any of these don't go to 0, then we probably went the wrong way. We've debited when we should have credited, or credited when we should have debited, and then we can just fix it. Go the other way. Do it the right way. Go the right way. And then we're going to go over here and just continue. These are all going to 0 out. Land. Then land is going to 0 out. And then the investment is going to go down to 0. Then the building. And see, I picked something out wrong over here because it didn't go to 0, which I totally did on purpose. So I'm going to try it again and say, okay, it should be that 43. And that'll make it go to 0. And then the building is the 2,420,000, and then the accumulated depreciation, which is a credit balance contra asset, goes to 0. So we went the right way there. That's a common error point. And then we've got the license, and then the liabilities. So liabilities going down to 0. Now note, as you do this, it's a bit more complicated when you pull in the taxes, of course, because you might have different tax consequences as well. But we won't get into that right now. We're going to be posting this out, the 108, so the 108, then we've got the 1,090,000, and then this is a contra liability, so notice we're going to credit it to go down, common problem or errors to make that go the wrong way, and then we're going to go up top to the investment. So then we have the investment, which we're going to say this is going to be equal to the investment, so that's all we have now. We got this one number. Now, if they gave us cash, then all we would have is cash, that one number. Then when we liquidate, we would just pay out the cash, right? So now we got that one number, which is going to be the investment, the common stock. And then I'm going to go down here and say the gains on the income statement. So I'm going to say there's a gain on the income statement down here. All right. So now we have an income statement number. Okay. So now we have a much more simplified item here. This thing has been completely gutted. What are we left with at this point? We're left with this one number, which happened to be stock instead of cash. They paid us in stock, so that's fine. And then we've got the equity section, which includes the equity, the common stock, additional paid in capital, and these other kind of equity things that are just confusing things. And then our revenue that we just included now, equity all representing, what is owed to the owner. So this is the other side. So how can we clear this thing out? Now we need to liquidate now. Well, let's close this out. First, I'm going to close out, just like a closing entry, this one revenue account, and I'll close it out to retained earnings, which is a typical, closing entry at the end of the year. So I think that's the easiest way to go about this. So we'll say, all right, that's a credit, like a revenue account. Let's debit it to our closing entry for, and I'm just going to say negative, let's say of that number. And then we'll debit it into, and then we'll credit it into the retained earnings, right? That's going to go into the retained earnings. Let's do that. So I'm going to say, all right, this gain, I'm going to close that out just like a closing entry. I'm going to close that out. We're going to put it into the good old retained earnings account. So now we got the retained earnings. And then we would take our investments and basically issue them out. So we're going to close everything out. So now, the common stockholders are going to basically be issued out the investments in P, the common stock, to the owners of S down here. And when that happens, we'll be liquidated. And again, if it was cash, you would think of it as basically liquidating out the cash that has been given. It's a little bit more complicated when you got the item being the investment in P. I mean, you could think of them liquidating the investment in P by selling them, right? And then giving out cash, or passing out the investments to close out the company. So now we got to basically do whatever we got to do to close this out. So you'll note, of course, bottom line from a journal entry standpoint is this amount, the 2,552,200, is going to be equal to the equity, all this equity. So from a journal entry standpoint, it's pretty straightforward. I'm just going to do whatever I need to do to make everything zero at this point, right? So the equity all needs to go down to zero. So I'm going to say, all right, well, there's common stock. It's got a credit in it, so I'm going to debit it to make it go to zero. And then here's the additional paid in capital. The additional paid in capital has a credit in it, so I'm going to debit it to make it go to zero. Once again, don't pick up the number on the right, because you'll end up with a circle reference when you post it. So I'll have to hard code a number down here pretty soon, but I'll use formulas when I can. And so there's the 21. We're gonna have to debit this. Now the retained earnings, I can't use a formula because I can't pick up that beginning number, and I can't pick up this number because it'll result in a circle reference. So I'm gonna have to hard code this number 1451200, and then we have the treasury stock that's there. Well, that's going to have to go to zero from a journal entry standpoint. So that's going to be actually a credit. It's on the wrong side. Let's do that over here. That should be a credit. And then the other thing that needs to go to zero, the other thing that's here, is this investment in P. That needs to totally go to zero too. So we're going to say this is negative. And again, I can hard code that, but it should also be the plug. So I can use my good old negative sum, and it should then equal the same amount. So there's the 2,552,200, 2,552,200. Let's post it out, and then we'll liquidate this thing. So here's the common stock. We're going to say, all right, common stock needs to go to zero, debiting that one to do so. And then the additional paid in capital is going to go to zero with debiting that one to the 507. Additional paid in capital for the other stock, which is, I think, preferred stock. If you were to read that, it's going to go to zero. Something's in this one, so I'm going to say F2 plus F2 so I can add the retained earnings. So it goes to zero. Treasury stock is going to go to zero here. And then we're going to then post that last piece to liquidate this thing right there. Something's in it, so I'm going to say F2 plus F2. Scrolling back down and going through to that investment. So investment, there we have it. So now we have liquidated this one. So this company is now gone. The stockholders have been issued the value that was given, which was the investment in P, presumably at this point. And now it has been liquidated, and P up here now is holding all of the assets and liabilities, which have now been valued at the fair value, as well as the goodwill that was resulting of this kind of market kind of sale type of transaction. Now, again, note that the liquidation process down here could be a little bit more difficult because you do have to, from a tax standpoint. So from a tax standpoint, you might have to think about the types of things you sold, right? Because, is it a normal type of sales? Is it capital gains or something like that? And whatnot. You might have different bases in things for the building and equipment, the long-term assets and that kind of stuff. So from a tax standpoint, it will be a more complex in some ways, but again, that's taxes. So so this is what we have on the book side of things, and it's it's fairly straightforward when you look at the overarching account totals for it. Okay, so that's it for now. Let's get out of here.